On June 7, though, U.S. authorities signed the Fiscal Responsibility Act, suspending the debt ceiling for 19 months, ending a months-long struggle and temporarily avoiding a catastrophic blow to the U.S. economy and financial system. However, the ensuing credit crunch storm and the imminent and even bigger U.S. banking crisis have made Wall Street, which is already devastated, uneasy. When the imminent U.S. recession is expected, U.S. Economics, which has successfully predicted the subprime mortgage crisis expert Nouriel Roubini, said in an interview with the media on June 5 that the crisis after the passage of the U.S. debt ceiling agreement will be even more dire. Roubini further warned that, in addition to damaging the credit of the United States, the repeated standoffs on the debt ceiling in the United States have caused profound damage to the dollar and U.S. debt, making U.S. creditor countries begin to lose confidence in the ability of the U.S. to repay its huge debt. Accelerate the process of de-dollarization in countries around the world. At the same time, in the next few weeks, a bigger storm of credit tightening in the U.S. financial market is coming. Goldman Sachs also warned in a report released on June 5 that the market may be in the third quarter of 2023. There is a phenomenon of dollar shortage, and the core logic behind this is actually very simple. Because, in order to enrich the account capital flow, the U.S. Treasury Department is about to issue a frenzy of bonds, which means that even more troubles may be brewing for the U.S. banking industry and enterprises when the Federal Reserve is still shrinking its balance sheet. Citibank estimated in a report released on June 5 that after such a large-scale liquidity draw by the U.S. Treasury Department, it will bring severe shocks to the U.S. financial market and U.S. debt, and further damage investors' trust in the U.S. banking system. The latest data and news are reflecting this trend. The data released by the U.S. Treasury Department on June 2 showed that as of May 31, the cash balance of the Treasury Department fell to only $22.8 billion, reaching the lowest level in October 2015. Running out of food and on the verge of bankruptcy, creditors are urgently needed to take over their huge new debts to maintain their luxury. Immediately afterwards, J.P. Morgan Chase predicted that the Treasury Department may issue $1.6 trillion in new debt to balance its spending and repay related debts. This pumping effect will lay hidden dangers for the already shaky U.S. banking industry, which further it confirms that after the passage of the debt ceiling, the United States is about to usher in a chain explosion of economic recession and more bank collapses, and further damages the financial prestige of the United States and the status of the dollar. Superimposed on the background that the global central bank, which is currently the cornerstone of U.S. debt, is moving away from or reducing investment in U.S. Treasury bonds, this will push the world's largest U.S. Ponzi scheme built on the U.S. debt house of cards to the brink of collapse. Because the secret of Americans being able to buy cost-effective products around the world and live a luxurious life through printed $100 green paper is based on the status of the U.S. dollar as the world's main reserve currency. But now the Federal Reserve uses the loose monetary policy of the U.S. dollar in different economic cycles to continuously dilute the global interest rate differentials and superimpose the U.S. abuse of its currency status function of the U.S. dollar, which has caused a lack of trust in the U.S. financial system, and investors will question whether U.S. debt can still be maintained. It is again regarded as the cornerstone of the world financial system. In this regard, Deutsche Bank believes in the latest Global Economic Risk Report released on June 5 that after the U.S. debt crisis and the regional banking crisis, will there still be a large number of investors paying for U.S. Treasury bonds? That could be one of the big risks for the market this year. This will even mean that the U.S. economy may enter a hollow state where the trillion-dollar debt deficit may not be able to pay, and the recent U.S. debt may be emphasized in terms of the total amount of U.S. debt held, the inversion of the U.S. bond yield curve, or the trend of reducing holdings. This logic. Immediately afterwards, Jim Rogers, known as a visionary Wall Street financial tycoon, explained in an interview with the media on June 2 that the United States is the world's largest debtor country, printing money and debts everywhere, and the actual total debt of the United States it is almost 7 times the amount publicly admitted by the U.S. Treasury Department, and the scale is close to $200 trillion. The debt problem is becoming more and more serious. The current debt problem in the United States cannot be solved by simply raising the upper limit. In the eyes of the American billionaire, a serious economic recession in the United States is inevitable, because it is facing a more complicated economic situation and the risk of debt default, unless the United States can really stop spending money and stop borrowing heavily. Otherwise, the U.S. debt economy will eventually pay the price, and the timing for the U.S. debt economy to pay the price is in the hands of the big buyers of U.S. debt around the world. Immediately afterwards, The U.S. financial website Zero Hedge analyzed on June 5 that if the risk of U.S. economic recession escalates and the systemic risk contagion detonated by the U.S. banking industry is superimposed, this will undoubtedly directly weaken the U.S. Treasury Department's ability to maintain the U.S., the world's largest U.S. debt pile. Under the background of the U.S. Treasury's inability to pay its debts due to its deceit, as well as the ability to export inflation and harvest seed nitrate, global central banks including Japan and China will continue to accelerate the liquidation of U.S. debt. If there is uncertainty increase, there is also the possibility of clearing the position of U.S. debt. Obviously, this will further weaken the dollar's ability to export inflation risk and collect seed nitrate, which may eventually lead to a slow loss of its status as the world's global reserve currency, as evidenced by the fact that the United States is currently increasing its debt. According to the analysis, the U.S. economy and financial market are facing these headwinds, the superimposed banking crisis continues to ferment, and the bank credit crunch may have just begun, and investors may be ready to press the sell button at any time. What about the U.S. Treasury and the Federal Reserve at this time? The financial research team of BWC Chinese Network has repeatedly emphasized on different occasions that because the U.S. dollar's main reserve and settlement currency status dominates the global commodity settlement and foreign exchange market environment, the U.S. can pass on its growing debt default and inflation risk spill over some economies with single economic structure, high external debt and shortage of foreign reserves collect seed nitrate. When the dollar shortage begins, the economy, assets and exchange rates of these markets will continue to be affected, but the matter is not over yet. As our research team has emphasized on different occasions, every cycle of a strong U.S. dollar in history will always trigger shocks in the economy and financial markets. The earlier vivid cases of this effect can be referred to Venezuela and Zimbabwe, and the latest case can also be referred to South Africa, Sri Lanka, Brazil, Myanmar, and Indonesia. In addition, Turkey, Argentina, and Chile have repeatedly defaulted on their sovereign debt, and their external debt problems have always been serious. In this regard, a new report quoted by the U.S. financial website Zero Hedge on May 15 pointed out that the economic and financial risks triggered by the U.S. debt default and the banking crisis are using different U.S. dollar cycles of tightening and loosening, combined with the currency status of the U.S. dollar transferred to some countries with a single economic structure and relatively fragile foreign reserves. In addition to the above 10 countries, there are also 16 countries including Lebanon, Czech Republic, Poland, Bahrain, Pakistan, and Egypt, facing the dilemma of dollar shortage or rising dollar financing costs. Because the economies of these countries have fallen into the fragile mode of severe currency depreciation and debt crisis respectively. This further confirms that as the US dollar index fluctuates and rises, in an environment of supply chain shortage, economic growth sinking and inflation still high, the spillover effect of US dollar index fluctuations will be indirectly transmitted to the financial markets and commodity assets of these economies, and every strong dollar cycle in history always triggers a crisis. Therefore, the answer is obvious. The Federal Reserve and the U.S. Treasury Department will covertly and accelerate the transfer of high inflation and debt default risks. In addition to harvesting their own people, they will continue to harvest the above economies with obvious economic structure and financial debt problems. The recent slump in Vietnam's economy and export market means that the attracting effect of this round of U.S. harvest cycle on the market is still continuing. Obviously, when the United States may transfer the risk of default to many countries, or even artificially create a dollar shortage in some markets, this will accelerate the process of global de-dollarization. Against this background, U.S. Treasury Secretary Yellen warned in an interview with the U.S. media on June 4 that the U.S. banking crisis is not over yet, credit conditions will also be tight, and some U.S. shadow banks with lower risk resistance capabilities. What we are facing may be a crisis that will erupt at any time. In the current environment where some countries want to start replacing the US dollar, our losses will become more and more severe, and the US economy will likely fall back into recession, which will further damage the financial prestige of US debt. End.